So potentially any stock listed on the MSCI World Index can qualify if it has the type of criteria that we like. That's really important because it's quite different to other dividend-based methodologies. Our starting point is the broad market. We divide the world into 24 different industry groups and 4 different geographic regions. And then within that we apply a relative dividend hurdle. Stocks that have above average dividend criteria within their industry group can qualify for the next stage of our process. The next stage of the process is then to make sure the dividends are healthy, that they're sustainable, but most importantly that they have the potential to grow over time. So for us the sweet spot is always dividend yield and dividend growth combined together rather than just one or the other. So elements that help you identify stocks with strong potential for dividend growth are really quality metrics, financial quality, making sure the companies are not overly stressed in terms of their current level of dividends. So we like a modest payout ratio, for example. So what percentage of earnings is being used to finance the dividend? And then the third stage of the process is where we bring in other metrics. ESG comes into the equation at that stage, valuation comes into the equation, where we try to pick the best stocks in each individual industry group, in each geographic region, to build a diversified portfolio with the type of financial metrics that we believe drive alpha over time. As a fund manager, our job is to deliver excess return over benchmarks. And one of the reasons we like ESG is that we think it's helpful with that. It absolutely is a quality measure. What you see with companies that have higher ESG scores or improving ESG scores is that they tend to have a longer term time horizon. ESG doesn't necessarily deliver alpha on a quarter by quarter basis, but if you think about it on a rolling 3, 5, 10-year basis, companies that are oriented towards, well, how is regulation going to change in our industry and how does that impact on our business, tend to do better in the long term. Companies that avoid very negative ESG events, again, tend to perform better over the long term. So ESG helps with risk management. ESG helps identify companies with higher quality, but it also helps identify companies that have better alpha potential. So in addition to the financial characteristics which speak for themselves and the dividend profile that kind of speaks for itself, if you think about the underlying company behavior, we think you get exposure to much higher level of quality and much more reliable businesses in terms of the earnings profile that they produce. Part of that, if you think about it in an ESG context, is the level of governance that you get. These are typically much better governed companies. Lower levels of financial accruals, for example, would be one characteristic that you would get. A longer term time horizon in terms of how the management teams are thinking about the industry that they belong to. And obviously the return profile itself, the stability of the earnings and the stability of the dividend is something that's welcome. And within a risk spectrum, it's a much lower risk way of generating returns from equities than, for example, a high beta or a high multiple or a very growth oriented approach. The process has been consistent now for over 15 years. And the other point is the stability of the investment team. That the current group of individuals that run the strategy, we own the track record. We've devised the strategy, we've implemented the strategy, and we've watched the strategy grow to its current level of AUM. And the business now has over 15 billion Canadian dollars in AUM. It's entirely institutional, so we don't have a retail business. All our business comes from third-party wins in the institutional marketplace, and I think that's a real kind of testimony to the quality of how we manage money and the support that we give to clients.